Investors, you have never had it so good. New research published by Morningstar and looking at investment fees across Europe shows that fees are on average significantly lower than they've ever been before. The research looked at a range of categories for equity and fixed income funds, and it looks at performance of the fees between 2013 and 2020. It found that on average investors are paying fund fees of 0.69%. That is down nearly a third, 31% since 2013. Now, before we dig into this research, please do take a second to subscribe to this channel. I'm Martin Bamford, a chartered financial planner from Informed Choice, and I make videos about personal finance, investing, and happiness. So do subscribe so you don't miss out on any videos in the future. But let's dig into this research from Morningstar, the European Investor Study, and find out what all this means, what paying less for fund management means for you as an investor. So let's take a moment now and dig into this study, the European Fee Study from Morningstar, work out what it means for you and I as investors that we're paying less in fees than ever before. Now, it's incredibly important that we pay lower fees when we invest money, and that's because fund fees are a reliable predictor of the success of an investment fund. And you're probably thinking at this stage, hold up Martin, aren't you supposed to be saying as a financial planner that past performance is no guarantee of future returns, etc.? Well, yes, that is true, but when it comes to selecting investment funds, it is fair to say, it's accurate to say, that paying lower fees gives you a much better chance of success, of higher returns in the future. And various academic studies have proven this. It's simply the case that the less you pay away in fees, the more money you keep. So your returns from investment funds with lower fees are higher. So it's a good predictor of future returns on that basis. Various academic studies tell us two things about lower cost funds. One is that these funds have a much better chance of survival, of actually being around in the future. And the other is that they have a much better chance of outperforming their peers. So lower cost funds are a good thing. And it's why one of the fund selection criteria that we put in place at Informed Choice when we select funds to recommend to our clients is, yep, you've guessed it, low cost funds. So we choose funds which have lower costs because we know that's a reliable predictor of future success. That's why one of the fund selection criteria that I put in place when we're selecting investment funds to recommend to our clients at Informed Choice is, yes, you've guessed it, low cost. Back to this research then. So Morningstar looked at 10 equity categories covering both broad exposure but also single market exposure, single country exposure, and also 2 fixed income categories. Now, the reason they picked these 10 equity and 2 fixed income categories was they believe this is what most investors, a typical investor, would have within a well-diversified portfolio to give them a core allocation to the various equity and fixed income markets. And as I mentioned in my introduction, fees for these investment funds are coming down. Since 2013, down by nearly a third. They've fallen 31% on average to reach 0.69% in October 2020. The average fee charged by industry fell as well. It was down 19% since 2013 to reach an average of 1.17%. Now, when Morningstar talk about the average fee charged by industry, they're combining a number of different fees that you pay as an investor. So the cost of the fund, the cost of the platform on which that fund is held, and also the cost of advice. And it's positive to see overall the total cost of investing with advice falling too, according to this European fee study. Now, of course, you can go it alone, you can save on that cost of financial advice, investment management advice, but as my previous video shows, the value of advice, the benefit of working with a financial advisor, with a financial planner, adds up, and it's a significant value add. It adds up to a net investment return on average of 3% a year. So by all means go it alone, but just be aware that you lose out, you miss out on that value added by investment advisors. So what is driving down the cost of investment funds? Now, you might have guessed the punchline by now, because unsurprisingly, the reason that investment funds are becoming cheaper is the rising popularity of passive or index tracker funds. Morningstar isolated the costs of these funds, looking back to 2013 to October 2020, and they found that on average, index tracker or passive funds had fallen in cost by 30% during that time, compared to just 17% for actively managed funds. So come on, active fund managers, you need to do better. You need to get better at cutting your fund expenses. Another interesting finding in this research is that the flows of money into the cheapest funds in each sector were significantly greater than the flows of money into the most expensive funds in each sector. So investors are actively selecting cheaper investment funds. But the study also found something quite interesting about those cheapest funds in each sector, and that was there was a tendency for investors to switch away from the cheapest funds, the cheapest actively managed funds, to even cheaper index tracker funds. So more investors in cheap funds move into index tracker, even cheaper index trackers, than investors in expensive funds move into index trackers. I found that one quite interesting. So I guess what's happening there is an investor who's quite savvy is already selecting funds based on low cost, and they think, well, in for a penny, in for a pound, I may as well go really low cost and move to an index tracker fund, a passive fund, and keep moving down the cost scale. So something for fund managers to watch out for. They do need to be aware that if they do become the cheapest in their sector, all of a sudden they're not competing against the universe of actively managed funds, they're also competing against much cheaper index tracker funds. And the ever popular ESG funds, or environmental, social and corporate governance funds, these are becoming cheaper too. So the average cost of an ESG fund, 0.57% in October, compared to the average cost of a non-ESG fund of 0.71%. Now historically, I think there was a bit of a belief, a bit of a myth, that ESG or green or ethical funds were more expensive, that you paid a bit of a premium as an investor to get an ethical fund. And we've known for years that is simply not the case, that ethical funds, ESG funds, are not charging investors a premium. And in fact, as this research shows, they are cheaper than non-ESG funds. So it's a lower cost alternative if you want that active fund management. Why is this so important? Why am I banging on about the cost of investing and keeping fund fees low? And that is because in the same way that investment returns compound over time, what Albert Einstein allegedly referred to as the eighth wonder of the world, compound interest or compound investment returns, so do investment fees. The investment fees compound over time too, and they diminish your returns. So as I mentioned earlier in the video, you can control this. This is something completely within your control. You can get a better investment return by cutting the cost of investment funds. So this is really important. It's great to see from this study that the fund management industry is waking up to the need to cut their costs. It's an insanely profitable sector. As I said when I quoted about this in FT Advisor earlier today, there's plenty of fat to cut. These investment fund managers can afford to charge less, still make profits, and everyone hopefully is happy on that basis. How much are you paying for your investment funds? Let me know in the comments below. Thank you for watching this video. Do take a second to subscribe to make sure you don't miss out on any future videos I make about personal finance, investing and happiness. Until next time, I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.